Welcome back to Market Minutes. We just wrapped up Q2 2025, and today we're going to be taking a look at the U.S. I'm joined by Sandor, Managing Director of Peakhill Capital U.S. Thanks for joining me, Sandor.
Thanks for having me, Chaim.
Sandor, in Q2, give me a macro overview of what we saw in multifamily in the U.S.
Believe it or not, I'm going to say, stability in interest rates. I think the Fed, speaking loudly that they're not ready to lower rates. And I think that's held up in the market. So rates have remained relatively stable, which is what investors need to come into the market. So we are seeing investors come back in slowly because there is some sort of stability here on the interest rate side.
I've noticed that particularly in the affordable housing space, the B and C class units, we've seen a lot more activity, a lot more trading going on. Luxury units, they've softened somewhat. Maybe you could speak to that a little bit.
Well, a part of that is cap rates are below interest rates. So buying long-term investments with negative leverage isn't that appealing. Where you are seeing money start to come back into the market is on the value add side. If you're going to borrow at 8+% floating rate, you're going to need to be able to position your asset to grow the top line, which effectively grows the bottom line. We're seeing properties have renovation rates go $200-$300 higher when they move from C to B. So that's what we're starting to see. And I think it's a great time to be a bridge lender in that space. Plus, home sales are not moving. No new product is being built. And we're seeing, more and more people that would typically move out of the rental pool into single family are staying. So all those are contributing to what we're seeing in the market is a strength in the B and C space.
That's interesting. I know that prior to interest rates having run up, there was a lot of value add plays, people taking on interest only loans and then kind of getting stuck when rates ran up. But it sounds like now that rates have stabilized, that market has come back somewhat.
I think if you look at those properties that were built with the intent of doing value add or purchased with the intent of doing value add, a lot of those business plans were successful from the point where they actually went in, renovated the units and pushed rents. Where they weren't successful was they bought at very low cap rates and they can't exit those deals in terms of the valuations they had set on them. But the business plan fundamentally worked. And today we're seeing people buy at the right cap rate where they can go in and implement the same business plan of renovating a C or a B minus asset to a B, push rents a couple $100, improve the standard of living by adding amenities and improving the unit interiors, delivering a better product. And there's ample income in the market to move from that B minus to B plus space.
Got it. So focusing on another aspect of the market, I've noticed that there was certain geographies, particularly Austin, Dallas, Nashville, Miami, where we've seen significant new supply come on. What's happening in those markets now? Are we seeing absorption? Are we seeing more construction coming in? Or are investors still focusing in those areas? Give me a little highlight into the areas where we've seen a lot of new supply come on market.
Yeah, well, mostly you're seeing new supply in the markets where the demographics are growing. So long-term, these remain really desirable places to invest, like Austin, like Miami, because the population growth there, the income growth there, the job growth there. We've seen a real slowdown in new construction starts for the last 2-3 years. And, the belief is that most of the markets with maybe the top 10 or so have really started to flatten out and reach the peak. And what you'll probably see is in markets like Austin, you have maybe, another 12 to 18 months. So most of the country has seen that in the rearview mirror. There are still a dozen or so markets where we expect the next 12 to 18 months to still represent some softness. But after that, it really feels like there's going to be a disconnect between demand and the new supply because so few people are getting a shovel into the ground to build. The banks have stopped lending in those markets and the cost to build remains high and the financing costs are too high. So all the dynamics for housing and rentals remain strong on a macro level. And add to that, as we grow the economy and we don't build new housing, that's going to sort of flip things over. And a lot of people think that's going to occur in the next 24 to 36 months where we'll see, housing tighten up and rent growth again in those markets.
So as that market changes, to what impact is housing market impacting the rental market?
So I think high interest rates are slowing down development. It's slowing down home sales because most people that have a long-term mortgage below 4%, they don't want to replace it with a 6.5% or 7% mortgage. So they're not selling. So the supply is on the market. It's keeping housing prices up. There's no new development. And that's ultimately all very good for the rental space. The renters that would normally mature into first-time home buyers, we're not seeing a lot of that. So that demand through the economy growing is strong, through the lack of people moving out into the home buying market isn't happening. So it's creating pressure for upward rents that we're projecting in the coming years.
All that being said, what's top of mind heading into Q3?
Well, we're certainly keeping our eye on the possibility of tariffs triggering inflation and how that it might impact things. It could slow the economy, but it could also keep rates high. Both those things, I think, lock people into rental housing. So I think from either side of the coin, I think the outlook for multifamily rentals is still a very good one. I'm optimistic. Again, I think the U.S. economy remains strong. I think we're still not seeing a ton of institutional investors flood into the market. Perhaps with 899 being removed from the big beautiful bill, which was going to potentially have adverse tax consequences to a lot of investors that were foreign. That goes away. Hopefully that helps spur foreign investment into the U.S. market. And as we watch whether or not tariffs have any sort of impact or a new Fed chair would potentially change things. Those are the types of things that I think a lot of people are looking high level at, and we can't really predict. But if you sort of just look at the economy as a whole and try to focus on the things you can't predict, it does look like a pretty strong economy with strong demand for rental housing. So I think it's a great time to invest in the space.
I appreciate that. It's always good to hear what's going on south of the border. Thank you for your time today, Sandor.
Yeah, thanks for having me.